Welcome to StockTok's deep dive into Industria De Diseno Textil, the Spanish fashion and retail conglomerate better known as IDEXY. This company is the parent holding of Zara, Massimo Dutti, Pull & Bear, and a portfolio of other apparel and accessories brands that collectively operate nearly 7,000 stores across more than 90 countries. IDEXY is one of the world's largest fashion retailers and a critical bellwether for consumer discretionary spending and the health of the global retail environment. As of May 11th, the stock is trading near $15.07, sitting in the middle of its 52-week range of $11.80 to $17.34. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. IDEXY operates a vertically integrated fast fashion model. It designs, manufactures, distributes and retails apparel directly to consumers through company-owned stores and increasingly through digital channels. The company's core competitive advantage rests on three pillars: a highly efficient supply chain that can bring design to store in weeks rather than months, pricing power built on strong brand equity and customer loyalty, and a global real estate footprint that generates consistent store traffic across developed and emerging markets. The StockTok score on IDEXY is 50 out of 100, which signals a hold. The score reflects exceptional profitability and financial health, moderate valuation concerns, softer growth momentum, and notably weak institutional ownership. Let's examine each dimension in detail. Now, valuation. The question every investor has to answer: are you paying the right price? Let's start with the price-to-earnings multiple. IDEXY trades at 25.42 times trailing 12-month earnings, forward to 23.29 times. For context, this sits above the long-term average for luxury and fast fashion peers, which historically command multiples in the upper teens to low 20s. The price-to-earnings growth ratio, or PEG, which divides the PE multiple by expected earnings growth, sits at 1.32. A PEG above 1 suggests limited upside from earnings growth alone. On an enterprise value basis, the stock trades at 13.21 times EBITDA, which is neither particularly cheap nor expensive for a mature global retailer with IDEXY's profitability profile. The most important valuation signal comes from our discounted cash flow analysis. The stock is currently trading at a 68% premium to intrinsic value, meaning the market is pricing in significant optimism about future cash generation and margin expansion. Now, the latest earnings results are crucial context. In the most recent quarter, IDEXY reported $9.81 billion in revenue versus an estimate of $39.86 billion. That represents a material miss, and more concerning, revenue declined 2.7% year-over-year. The company did report operating income of $2.37 billion and net income of $1.83 billion, demonstrating that underlying operational efficiency remains intact even as top-line momentum has stalled. Wall Street analysts covering the name have a consensus mean price target of $17, with a single analyst providing that estimate, implying approximately 13% upside from current levels. Taking both signals together, the DCF and the analyst targets, a reasonable fair value range in our view sits between $14 and $17. Market sentiment around IDEXY leans neutral, with insufficient recent news flow to suggest either conviction buying or rotation out of the position. The bull case argues that IDEXY is a best-in-class operator with pricing power and efficient capital allocation. The bear case rests on slowing revenue growth and valuation that offers limited margin of safety for that growth risk. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point accounting quality checklist that flags financial manipulation, stands at 6 out of 9. This score is respectable but not exceptional. It indicates the company is profitable and generating cash, but with some modest concerns around asset quality or working capital trends. More importantly, the Altman Z score, which is a bankruptcy risk model that incorporates profitability, liquidity, and solvency metrics, sits at 8.76, well above the 8.3 threshold that marks the safe zone. This tells us IDEXY is financially fortress-like and carries virtually zero bankruptcy risk. Now let's examine the balance sheet directly. The company's cash-to-debt ratio is 6,405.62, which might initially seem confusing, so let me clarify. This exceptionally high ratio reflects the fact that IDEXY carries essentially zero financial debt while maintaining substantial cash reserves, giving the company tremendous financial flexibility. Debt to equity is 0.00, confirming a debt-free capital structure. Interest coverage, the ratio of operating income to interest expense, is 26.46 times, meaning the company generates more than $26 of operating profit for every dollar of interest obligation. This is fortress territory. The current ratio, which measures short-term liquidity, sits at 1.54, indicating the company has $1.54 of current assets for every dollar of short-term liabilities. All of these metrics paint a picture of a company with exceptional financial discipline, strong liquidity, and virtually zero refinancing risk. The balance sheet is not a constraint on this business. Next up, profitability. Is this business actually making money efficiently? Let's start with return on invested capital, or return on invested capital, the percentage return the company generates on every dollar of capital it deploys into the business. IDEXY's return on invested capital sits at 30.26%, which is genuinely exceptional. For context, most mature industrial companies generate returns between 8 and 12%. A return on invested capital above 25% signals a company with a durable competitive moat and minimal capital reinvestment requirements relative to earnings power. Now let's walk down the margin stack. Gross margin, the percentage of revenue remaining after the cost of goods sold, stands at 58.25%. This is pristine for retail and reflects the company's pricing power and efficient supply chain. Operating margin, which measures profitability before interest and taxes, sits at 20.16%. This is the true earnings power of the business after absorbing all operating expenses, including distribution and store labor. Net margin, the percentage of every revenue dollar that flows to the bottom line, is 15.6%. And importantly, free cash flow margin, the percentage of revenue that converts to actual cash the company can return to shareholders or reinvest, is 16.57%. The most recent quarter reinforces this profitability story. With net income of $1.83 billion against $9.81 billion in revenue, the company is maintaining its margin profile even as it navigates revenue headwinds. This is a sign of pricing power and cost discipline. The bull case points to margins of this caliber as evidence of an unassailable competitive position. The bear case would note that absent revenue growth, margin expansion has limited impact on total earnings power. Onto growth. Is this business expanding, and at what rate? Revenue has grown 7% over the trailing 3 years and 13.5% over the trailing 5 years. These figures reflect a maturing business in developed markets offset by expansion in emerging geographies and the continued penetration of digital channels. The most recent quarter's negative 2.7% revenue decline is a concerning inflection point. It suggests that macro headwinds, whether from consumer spending pressure, competitive intensity, or store traffic normalization post-pandemic, are now offsetting international growth tailwinds. Book value, which represents shareholder equity on a per-share basis, has grown at 6.2% over the trailing 3 years, a rate that lags overall revenue growth and suggests the company is deploying capital primarily to shareholders rather than reinvesting aggressively in the business. This is consistent with a mature, efficient operator. The dividend yield stands at 3.26%, which is a modest income return, but consistent with a company that prioritizes shareholder distributions over high capital expenditure growth initiatives. The key question in our view is whether this revenue deceleration is cyclical, a temporary pullback in consumer spending that will recover as macro conditions normalize, or structural, reflecting secular shifts in consumer behavior and increased e-commerce competition that permanently lower growth prospects. Management has not yet provided forward guidance that would help us answer this question definitively, so investors are left to make their own assessment. For a business trading at a premium valuation, revenue stagnation or decline is the primary risk. Growth is where the thesis weakens. Now let's talk smart money. What institutional capital is actually doing with this name? The picture here is striking. 0 top-tier gurus, meaning the most prominent value and growth investors tracked by institutional databases, currently hold IDEXY in their portfolios. This is notable for a company of this size and profitability. Furthermore, only 0.1% of institutional 13F filers are net buyers, meaning fewer than 1 in 1,000 large-cap mutual funds and hedge funds are accumulating shares. For perspective, anything below 50% would indicate net selling pressure from institutions. This reading of 0.1% is essentially maximum indifference or outright avoidance from the smart money crowd. Insider ownership stands at 0%, which means management has virtually no personal skin in the game. This can sometimes signal misalignment between founder interests and shareholder interests, though in the case of a mature public company, this often simply reflects historical founder distributions. Over the past 3 months, there have been 0 insider buys and 0 insider sells, indicating no meaningful management activity. The smart money dimension of the StockTok score reflects exactly this: 0 out of 20 points. No gurus hold it, institutions are not accumulating, and management is not buying. This is the biggest red flag in our analysis. When you combine fortress balance sheet profitability with 0 institutional conviction, it often signals that the smart money sees something in the valuation or growth profile that makes the risk-reward unattractive at current levels. The absence of guru ownership combined with slowing revenue growth and premium valuation creates a skepticism that is worth taking seriously. And finally, the verdict. Let's bring it all together. On valuation, IDEXY trades at a material premium to its discounted cash flow value, leaving little margin of safety for disappointment. On financial strength, the company is exceptional, a fortress balance sheet with 0 leverage and fortress profitability metrics. On profitability, margins are pristine and return on invested capital is genuinely elite. On growth, however, the business is decelerating materially with negative revenue in the most recent quarter, which is a significant headwind at a premium valuation. And on smart money, institutional conviction is essentially absent, with 0 top-tier holders and minimal 13F accumulation. In our view, a fair value range for IDEXY sits between $14 and $17, representing limited upside of approximately 13% from current levels and downside risk of approximately 7% if macro conditions deteriorate further. This range reflects a business that is operationally excellent but facing genuine growth challenges, and valued at a level that offers little margin of safety for those risks. The latest quarterly results, negative 2.7% revenue growth paired with maintained margin profile, reinforce that the company is defending profitability while losing momentum on top-line expansion. Our thesis is as follows. IDEXY is best suited for the patient, dividend-focused investor who is comfortable owning a mature, slowly growing business with exceptional profitability and financial strength, and who is willing to pay a moderate premium for those qualities. For growth-oriented investors, the absence of institutional conviction combined with slowing revenue growth and high valuation suggests better opportunities exist elsewhere. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Industria De Diseno Textil. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.